Hello, everybody. Jeff Fratarcangeli here for another Fratarcangeli Friday Market Update. Welcome back. It's been a couple weeks, and there's been a lot of activity, starting with earnings. We've had 80% of companies beat earnings so far of the 60% that have reported for the S&P 500. That's up by about 10% on the average beat that we've seen going back now to 2011. I believe that's directly correlated to the fact that, one, earnings are strong, but also in the first quarter, we saw a number of companies guide lower because of the tariff outlook and the impact that they were going to be feeling. So the outcome was not as bad as expected, but certainly something we're continuing to watch. So earnings have been strong. Two particular companies that I'm going to mention today. One is Palantir, which has gotten a great deal of focus recently, and they've come out and shown us that they're going to bring in a record $1 billion quarterly revenue, and their outlook has been increased as well from roughly $3.90 per share up to close to $4.15 per share for the outlook in the coming quarter. They're also up approximately 7 to 8% in post-market trading on that news. So Palantir, someone and a company that we're watching very closely in the AI space, and we're seeing more good things to come. Eli Lilly, on the other hand, came out, blew through earnings, had very strong revenue and earnings per share growth, but they had a weight loss drug that did not meet expectations that drove the stock down between 13 and 14%. We're looking at that now to see if this is an area that we should take advantage of, and also looking at what the managers are doing across the different strategies that would hold healthcare and specifically a more value-oriented position like Eli Lilly. The next category that we'll look at today is economic data. Job creation. It's been something that's been talked about and polarized recently. In particular, the jobs creation in July, expected at 104,000 jobs, actually came in at 73,000 jobs. But even more concerning was the fact that the June and May numbers that were adjusted down by 125,000 and 130,000 respectively, for a total of roughly 248,000 jobs that had been downward revised, saying that those jobs were not created. This, along with the fact that in 2024, 818,000 jobs that had been reported were adjusted downward and said that those numbers weren't accurate. This brought on a release of one of the members in that particular division within that data point, and it's created a lot of questions and a lot of noise as to what was happening during the process of those job numbers being ultimately provided to us and then guided lower further down the path of the year. And what we also saw simultaneously is these job reports came out right around the election. So it's created a lot of questions that causes us pause, and it's going to bring us to the next Fed meeting that is probably going to bring them to consider the weakening job numbers and the fact that we're seeing a cooling economy and expecting lower interest rates in the near future. So that's something we're going to watch very closely. I'm going to just touch on next week's data, the CPI and PPI numbers coming out on August 12th and August 14th, and then we're going to have the Fed minutes that it's going to be released on August 20th. We're going to be watching very closely to that data and how that plays into the next move by the Federal Reserve, which is under extreme pressure and questioning as it sits today, as we've seen majority of the countries around the world lowering interest rates, and yet we haven't lowered interest rates yet here in 2025, which is a big drag on some of the small and medium-sized companies out there in the United States and the carry cost that they're enduring at a higher prime rate that they're attached to on revolving debt. So we're going to see what happens next there and how that plays out. Also, we have trade deals and new economic events that have transpired since we last met 2 weeks ago. We had the EU and the United States come together to form a deal that puts a level 15% tariff across pretty much all categories with the exception of aircraft. That's something that was interpreted as a very positive for the United States, not quite as positive for the EU. We also saw a rotation in market movement to different sectors for investments on the heels of that data news. We also were recently brought to understand that there was an executive order by our current president, Trump, to allow private investments inside 401ks. More to come there and how that plays out and how we need to be considering as we look forward on our retirement plan investments. So that being said, I want to say a few things that as we come upon September, we'll meet here in 2 more weeks in this type of fashion. But historically, September and October have been very volatile months. We look back to over the history of a 12-month year, the lowest returning months of the year are September, August, and sometimes October as well. So what does that mean for us? That means that we're probably going to consolidate Will it be 3%? Will it be 5%? Will it be 10%? What we do know is the market typically once a quarter will contract right around 3%, and sometime throughout the year will contract about 10%. But yet the market over the last 25 years has averaged north of 11%. So what we want to do is take advantage of these volatile environments, continue to dollar cost average, make sure that we have a proper balance in our portfolio, and stay the course in these questionable and volatile times that will reassess where we go next, but stay the course is generally the case. Not timing the market, but time in the market is something that I want to reiterate to all. So we'll be very focused on the next several weeks, as historically that's brought heightened concern. And we also saw some data out there about the sentiment for where we think the markets are going, bullish or bearish. We've seen a rise in bearish sentiment out there, and so we're going to keep a close eye on that. But I will reiterate what I said just a few weeks ago. I am very compelled for the next several years and the next couple of years for the market outlook and the economy outlook that will be broader factors that will bring us to the next chapter of where we're going in this marketplace. So I thank you all for joining me. I will see you all soon. Bye for now.